And there you have it, the closing bell after a momentous day at the New York Stock Exchange.
There's an announcement from the Federal Reserve that an interest rate hike is coming soon.
The Dow Jones shot up more than 400 points a few times during the day, but it took a sharp dive, ending the day down about 130 points.
Pretty much the same outcome as at the NASDAQ and S&P. They both saw swings throughout the day, but ended the day flat.
But the big story was the Federal Reserve's decision to keep rates unchanged for now, with plans to hike rates as soon as March. Jared Woodard joins me now to help us break down what is driving the market today. He is the head of the Research Investment Committee of Bank of America Global Research. Jared, welcome. Great to have you with us. So let's jump right into the news from the Fed. As expected, the Fed signaled it's getting ready to raise interest rates in early March, but will keep rates at near zero for now. Still, Fed Chief Jerome Powell did not rule out subsequent hikes every meeting. So what's your reaction to this news?
That's right. I'm glad to be with you because this is a really unusual moment in the markets. We're used to Fed hiking cycles. Investors know what to expect generally when the Fed starts raising interest rates. But something's very different on this occasion, which is that the Federal Reserve is raising interest rates not because they're concerned about unemployment, which has been the big catalyst for the last several hiking cycles over the past couple decades. This is obviously a different moment because the Federal Reserve is raising interest rates to combat inflation. That's something investors haven't had to contend with for several decades. And so it creates a lot more uncertainty in the market. Investors who are active today maybe weren't active 20 or 30 years ago. And so they're having to learn in real time what to do as the Fed embarks on a new course.
You know, inflation is up, as you said, historically high. I'm going to say this since it hasn't been this high since before I was born, so I'm just going to age everybody out there. The Fed wants to hike interest rates to tame them. Now, we won't know until March what those new rates will be. How aggressive do you think the Fed will be, or how aggressive should it be to get inflation under control?
Well, we expect the Federal Reserve to raise interest rates 4 times this year by a quarter of a percentage point on each occasion. The Fed's made it really clear that they want to be measured, but their language has also changed. And I think this is one of the things that was a driver of the markets today. They've made clear that they want to be very nimble and attentive to what they see as a new risk, that inflation could be more persistent than they had expected. Remember, last year, the rhetoric from the Federal Reserve was that everything was transitory. Today, the Fed seems to be on board with the view that inflation might be stickier and more persistent than people had expected. That means the risk is of more Fed hikes, not fewer.
All right, I want to ask specifically about the housing market and how these hikes will affect the housing market, because, of course, every industry is a little different in terms of how it responds to these interest rate hikes. But as we know, the housing market is already tight. The average price of a home continues to rise. So many people are priced out already. What is an interest rate hike going to do to an overheated housing market? And what should those people looking to buy a home now do and know before it happens? Should they rush to close deals as soon as possible?
Well, I think the big constraint in the housing market is, again, different from what we're used to. Normally, we think about the financing side of demand for houses. And there, what the Federal Reserve does with rates is really important. But lately, the problem is not so much that people can't get financing. Financing still is really affordable. Interest rates are incredibly low by long-term historical standards, I think just a bit above 3% on the national average. The problem actually is more one of supply, that there aren't enough houses for people, especially in the entry-level part of the market and the middle part of the market, and that creates a lot of price pressure. What the Federal Reserve may do this year as they hike interest rates may actually cool off some of that excessive demand in the housing market, and you might see buyers able to get in at slightly better deals than they are at the present with incredibly hot demand in many parts of the country today.
Jared, I know there's been so much volatility in the market and in the crypto market as well. I mean, the memes are endless. How are investors reacting to the announcement from the Federal Reserve?
Well, you've seen a lot of selling this year, not just in equities, but also in other more speculative parts of financial markets, as you mentioned. A lot of the froth, the real exuberant, sort of euphoric buying that characterized different periods over the past 1 to 2 years has really been taken out. You see investors having to pull back as things get a lot riskier and more volatile than expected. Some of that's actually really healthy for long-term investors. I think what you can expect to see for the rest of the year is more bouts of volatility as investors contend with such a different environment. I think instead of looking at the unemployment rate data, which tends to be a huge driver of investment cycles, we'll continue to focus more on the inflation data to see whether this inflation is just as sticky as the Federal Reserve thinks, or whether it's still more related to COVID restrictions, to supply chain issues, and whether those can be resolved. There's still a lot of uncertainty on both sides of that debate. And so I think investors should expect more periods of volatility, but also more opportunities opening up this year as the Federal Reserve decides how to pursue new policy.
So bottom line is, though, interest rate hikes are not a bad thing. Is that right, Jared?
I think they're not a bad thing if you're a long-term investor, especially if you have cash ready to deploy when great opportunities open up.
All right. Jared Woodard, thank you so much for joining us. We appreciate your financial insight.
Thanks.